Hey everyone, I'm Matt Dolan with Dolan Divorce Lawyers in Connecticut, and today I'm going to talk about tax considerations that you will want to keep in mind or deal with if you are going through a divorce. So first off, you have to figure out after your divorce whether you're going to file a single tax return or a joint tax return with your spouse. So if you are still married as of December 31st, so if you're still married at the end of the year, then you can file a joint tax return for that year. So let's say you get divorced in January, you still have to file your taxes for the prior year. You can file a joint tax return after your divorce so long as you were married at the end of the prior tax year. If you're filing a joint tax return, you'll have to pay less in taxes than you would if you and your spouse file separate tax returns. If you're divorced in January, you can put in language that says the two of you will cooperate in filing a joint tax return for the prior tax year and equally divide any tax refund or amount that is owed. So that's an example of language you can put, or you can equally divide it, or somebody gets all of it, somebody gets none of it, etc. But it generally makes sense to file that joint tax return to save you and your spouse money overall. Now, if you were divorced before the end of the year, you do not have the option to file that joint tax return. So you will have to file either single or head of household if you have dependents. And after the divorce, you're also going to want to factor in the fact that you can no longer file jointly. You'll presumably be in a higher tax rate, maybe, depending on your income and the income of your ex-spouse. So you're going to want to just make sure when you're looking at alimony and child support calculations and each party's income, what it will be after the divorce, you want to make sure you consider the fact that you're no longer going to be filing a joint tax return. You will either be filing single or head of household. In addition to that, if you have children, you're going to have to determine who will claim the children as dependents on their taxes. Generally, how it's done after a divorce, so long as, child support is being paid, or if you have a 50-50 plan and there's no child support being paid, generally folks will alternate or share those dependents. So if you have two children, you might each claim one, or if you have one child, you might alternate, saying one parent claims a child on even tax years, the other claims the child on odd tax years. Or if you have two, again, you might each claim one, but when one child ages out, you say, okay, at that point, we will alternate the remaining child. So usually it is split. The only situation where it's not split, generally speaking, is if one parent is the primary custodian of the children, so has the children primarily, and then the non-custodial parent just isn't even paying child support and isn't properly contributing financially. In that situation, it's more likely that the primary custodian of the children will get the tax deduction. You're also going to want to make sure you deal with any tax deductions associated with real estate. If you're getting divorced and you are filing a joint tax return, it doesn't really matter. But if you're filing separate tax returns and you own a house, for example, you're going to make sure you deal with who gets the tax deductions associated with that house. So it's, mortgage, interest, real estate taxes, etc. are tax deductible. There's some other things that are tax deductible. And you might say, okay, the parties will equally divide the tax deductions that are associated with the property. And that's usually done if you're selling the property and it's, you're dividing up the proceeds. Or if one party is keeping the house, generally speaking, that person will be entitled to all the deductions associated with the real estate. So you're going to want to make sure you deal with who gets those deductions for any years in which you are not filing a joint tax return. You also want to keep in mind that alimony and child support are paid in after-tax dollars. It used to be the case prior to 2019. If you were divorced, alimony was tax deductible for the person who was paying it, and taxable as income for the person who is receiving it. That is no longer the case. Alimony is paid in after-tax dollars, as is child support. Child support was always paid in after-tax dollars, so you're just going to want to keep that in mind, that there's really no tax deduction associated with alimony. You're going to want to look at the tax implications of various assets that you're dividing. So obviously, if you're going through a divorce, you are dividing up assets. Not every, $100,000 asset is really equal in value, because you have to make sure you're thinking about the tax implications of those assets. So as an example, the $100,000 in cash for wife to receive and husband receiving $100,000 in a 401k, those are not equal assets, because the husband will have to pay taxes on those 401k funds as he takes withdrawals, whereas you do not have to pay taxes on cash. Obviously, it's cash. So accounts like 401ks, IRAs, those are all pre-tax accounts. Pensions, you generally have to pay taxes on those distributions. So you just want to make sure you're fully aware of the tax implications of various accounts as you divide them up. Another one is, if you have a brokerage account, if you take withdrawals or sell securities and you have earnings from investments in that brokerage account, those are taxed as capital gains, which are a different lower tax rate than income tax. So 401ks and IRA, distributions, you pay income tax on those. Dividend income from brokerage accounts, that would be capital gains taxes. Now, a Roth IRA, any account that is a Roth, that is after-tax dollars, so those are essentially the equivalent of cash. And then, real estate, there could be capital gains implications also if you sell property for a profit. If you bought it for $200,000 and it goes up in value and you sell it for $500,000, there may be capital gains implications on those earnings. So if one party is receiving a house, you want to make sure you are taking into consideration the tax implications on that house. Now, if it's a primary residence, there are certain exclusions where you may not have to pay capital gains tax on that real estate. You don't pay taxes on up to $250,000 in gains, or if you're married, you don't pay capital gains taxes on up to $500,000 in earnings on a primary residence for real estate. So these are things you're going to want to talk to your attorney and accountant in detail of, just making sure you fully understand the tax implications of various assets. And then when accounts like a 401k or a pension are divided, you will often say, okay, husband will transfer 50% of his 401k to the wife. Now, that is done through what's called the Qualified Domestic Relations Order, which is a quadro, and that essentially transfers 50% of that account value to the other party, and there are no tax implications. Normally if you take a withdrawal from a 401k, you have to pay taxes and potentially early withdrawal penalties. But there is an exclusion from that. In the event of divorce, you can transfer it to your spouse without that being a taxable event. Now, when you or your spouse takes a withdrawal from the funds that are remaining in the account, you have to pay taxes on those withdrawals. But that initial transfer at the time of divorce is not a taxable event so long as you do it through a quadro. So those are the basics on the tax implications you want to consider if you are going through a divorce. As usual, if you have any additional questions, you can contact our office. And if you're looking for representation in a divorce or family law case, we would invite you to contact our office as well.